Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, 7 investors, and welcome to the Friday edition of 7 Investing Now. My name, of course, is Daniel Brooks Kline. I'm the host of the program. I am live in West Palm Beach. I am joined by Matt Cochrane, who is a little south of me in Florida. Steve Symington, who's wherever Montana is. I'm not entirely sure. Apologies to my elementary school teachers. It's somewhere near Canada or like where Santa lives. I'm not entirely sure. And of course, Simon Erickson, who is in the lawless state of Texas. Simon, welcome to the program. We have some special announcements to make today. We are going to reveal the winner of our big contest that we had for our anniversary. Why don't you tell? We're not going to do this till after our top story. And our top story is, of course, passive investing. That's ETFs and index funds. So you probably have some of these in your 401k. Are they bad for the stock market? Before we do that, why don't you explain what we did to honor our first anniversary here at 7 Investing?
Sure. Yeah. Thanks very much, Dan. 7 Investing just turned 1 on March 1st, 2021. And we had a celebration throughout the entire month where we said our mission is to empower you to invest in your future. And we invited everybody to say, how have we empowered you? What does 7 Investing mean to you? Please tell us your story about how you found us, how we're helping you. We received a lot of testimonials from people, and we randomly selected 7 winners for a free annual subscription to 7 Investing. We'll announce those on the program later today.
Steve did a TikTok video to the 90s hit, I've Got the Power. But he is, of course, not eligible. One of the things we get as employees here, as people who work here, is, of course, access to our service. It's hard to do our job if we didn't. It would be a little bit strange if we didn't. But let's get the show started. So let me give a quick rundown. This is a really busy show. At the top, we're going to talk about passive investing. That's ETFs and index funds. Are they bad for the market? Then in what we're watching, Steve is going to talk about President Biden's green jobs plan. Simon is going to introduce us to the market's very first publicly traded quantum computing company. I know what some of those words mean, but not all of them. And Matt, of course, is going to give us his favorite ice cream places in Southern Florida. Now, Matt is going to talk about JPMorgan CEO.
Only the top 20, though. Only the top 20. And it goes into, like, affecting the rankings was how close they are to my home. So
to get to 20 in South Florida, you'd have to include, like, the McDonald's McFlurry. We do not have good ice cream for a warm climate for the most part. I know there's some exceptions 14. To that. But he's going to talk about JPMorgan Chase CEO Jamie Dimon and his annual letter to shareholders. Then, of course, in the home stretch, we're going to talk about how we exit a position. That was sponsored by a comment someone shared with us on Twitter. And if you have questions and comments, we will take those as well. So it is very, very busy. So let's get to it. Is passive investing, ETFs and index funds, bad for the stock market? Simon, why don't you kick this off and sort of explain something I didn't know, that as of 2019, there's actually more passive money in the market than there is active money. And by active money, I mean individuals and sometimes, money managers going in and buying individual stocks rather than buying ETFs, which are baskets of stocks, more or less. Simon.
Yeah, that's right, Dan. And what we mean, kind of like you said, passive versus active investing, right? Are you an active investor that's actually making trades, picking stocks and buying them individually? Or are you putting your money wrapped up into an ETF or a mutual fund that's making those decisions for you, that tends to buy large baskets of stocks? And as you alluded to, Dan, we've now seen that passive funds, these passive vehicles for investment, now have more assets under management than actually actively traded stocks do in the United States. That's having some impacts to the market. A lot of people call this dumb money. It really just means that kind of baskets of stocks move in tandem together, and it introduces a lot of noise, which actually has some interesting implications for individual investors like us.
Steve, let's get your 10,000-foot view on this before we go into some of the nitty-gritty. I will point out there's $11 trillion passively invested in the market, which is the same number it would take to get me to visit Steve in the winter. So, Steve, your thoughts on ETFs and passive investing, which a lot of this.
So passive investing, I want to say passive aggressiveness, passive investing, it might actually be degrading, some of the advantage of individual investors, because what we see is massive amounts of cash kind of moving, as Simon mentioned earlier, and a lot of different sort of similar stocks and similar baskets moving in tandem with one another. So it's harder as individual investors and as stock pickers to find businesses that will materially outperform the rest of the market. So that's kind of the idea, is how passive investing, this so-called dumb money, so to speak, is creating issues for stock pickers who are actually trying to create alpha, really. That's a legitimate worry. And you can kind of argue that there is cause for concern, but it's not sort of this yet such a broad sweeping concern that I think that it's impossible to beat the market. And that's something we've sort of proven with, our individual track records and our track record as a team so far at Seven Investing, is it is possible to beat the market, but it definitely gets harder when you have so much money moving in tandem.
So I'm going to liken this to horse racing. I'm going to go back to Simon in a minute, as planned in our script here. Matt Cochrane, have you ever bet the ponies? Have you ever gone to the track?
I've not. I've never been to the track, so no.
So when you go to the track, how people bet is what creates the odds. Somebody is feeding back, so be careful with your speakers there. But it is one of those cases where if a horse has a great name, and the example I'll give is I was at the Belmont, which is in New York one year, and there was a horse named Captain Messier, named after Mark Messier, and it was a bad horse. It had like 3 legs and a limp. Like it was not, its jockey weighed 400 pounds. This horse wasn't going to win, but a ton of money went on it and it became a favorite. That can happen in the market. We saw that with the GameStop craze. That's active money. But if there's so much passive money in a stock, that actually makes it harder for active money to sort of push stocks in the right direction, or sometimes the wrong direction. But Simon, how is this impacting the market right now? Is it just increasing volatility and noise, or is it having real impact?
It's herd mentality, Dan. And if we kind of take a step back and go back in time and look at how money has moved and changed over the last several decades, right? 1978 comes out with a 401k plan. And this is a defensive investment. It's a passive investment for the most part, because you have these giant funds that are helping people invest for their retirement, right? We're moving away from pensions, which were defined benefits, to defined contributions, the 401k. And we put it in these giant funds that would kind of track along the entire market. By the way, I have a bit of trivia for our team here on the show and anyone who's watching. Do you know what the largest mutual fund in America is right now?
Ooh, that is... I don't have the teacher's edition, so I don't actually know the answer to this one.
Matt, Steve, any guesses or what it might look like?
I'd say maybe the Vanguard S&P 500 index, yeah. Okay.
And that is correct. It's the Vanguard Total Stock Market. Steve, you get the gold star today for picking that. It has $1.1 trillion of assets, and it's spread over 3,000 different positions. That is the entire market. You're buying the entire market with that. And there's now $1 trillion of assets that's just flowing with something so broad-based like that. And then you look at also other, innovations in investing, the Roth IRA in 1997. This was also a defensive one. You kind of save for your retirement. You did not want to take risk. But then in just the last decade or so, we've seen kind of more of a rise in algorithmic trading that is in subsectors of the market, Dan. So rather than going out and blasting 3,000 positions, we might go out and find an ETF that's just based on space economy, on retail, on financials, whatever it might be. So you've got these sub pockets that move in tandem that could still be tens of billions of dollars of assets. And so I guess my key takeaway from this is kind of evolved from a retirement, park it and forget about it for 30 years kind of vehicle that we've seen that was very defensive in nature, to more offensive, playing offense, investors looking for pockets of the market they want to invest in. But it's still herd mentality. It's still grouping a basket of stocks together rather than individual companies.
So I'll make a silly comment and then a serious one. I sent you guys a photo of my new license plate because it's in a Seven Investing license plate holder. That being said, my license starts with QQQ, which is a popular NASDAQ ETF. So I feel like, given what I do for a living, that my license plate is inadvertently sending the wrong message, because I didn't get to pick it. If you see me out there, I was going to share this on social media, and then I thought that maybe having my license plate out there on social media wasn't a great idea. But Simon and Steve, we're going to get back to you in a second. I know that I don't consider my retirement accounts, my 401k specifically, totally passive because I look at what's being bought and I know that I have exposure to some things I'd like to own individually, but I don't. I have significant Amazon exposure, for example, in my 401k. So I consider that owning Amazon. I know most people don't dig into the holdings of what they have. But is this mostly just people saving for retirement that are sort of setting it and forgetting it?
Steve, you want to go ahead? I have an answer, but please take the opportunity.
I was throwing it to you, Simon, but Steve,
yeah.
you can go.
I'd say yes and no. I mean, that's a lot of it, but I think there's a lot more young money going into the stock market, kind of as people have more disposable income and realize that it's a fantastic wealth generation tool. But I don't have a particularly informed, prepared opinion on that. Simon, what do you think?
Yeah, I mean, Dan, it was very highly structured by employers for so many years, right? For those watching the program that were investing 20 years ago, do you remember just the charts that would show the 1 year, 5 year, and 10-year return of your 5 options you have to put into your 401k plan? I mean, it wasn't going out, and most people weren't looking at, this prospectus, the summaries, the constituents in those funds. But now you've got so much access to information. You can go through and read annual reports. You can kind of look at individual equities and be much more selective about exactly the companies you want to invest in. I think that investing as a whole is continuing to evolve. And even though we're seeing the rise of these passive funds grow larger and larger in absolute terms, it's also a greater and greater opportunity for companies like ours and individual investors that now have access to more information to make even better informed decisions.
Absolutely. The more information you have, the more you know. And that's why one of the things I push when I explain 7 investing, and I spoke to some 17-year-olds yesterday in a sort of socially distant setting, and they were really into some really weird stock areas. And what I kind of said was, start with what you know. And the reason for that, they were talking about lithium mining in I don't even remember where, but South Africa or someplace. And it's like, no, look around your world and figure out what you know, because you've been following that business. Part of what we bring here is whether it's a company we've experienced or companies we've just been following for decades, is historically you build up that wealth of information. And now it's easier because the technology is great. Like, we're partnered with YCharts, and YCharts puts so much information at the tip of your fingertips. We're going to take your questions and comments. If they're not related to this, we're going to do it in the second half of the show, sort of after what we're watching. But I wanted to take a comment, the first one from Mike Fee, Sam Bailey, and Matt Cochrane, if you wouldn't mind reading that comment out loud.
Yeah, absolutely. Bill Ackman discussed this issue back in 2016, suggesting there is a bubble in indexing. The argument, if everyone becomes a passive indexer, then the returns of the major indices will start to lag in a major way as the stocks in the index become overcrowded and overpriced. And Dan, can I just follow up on that comment?
You can.
So Michael Burry said that actually the same thing in I want to say 2019 maybe, but he says passive indexing, passive investing, it just kind of ruins price discovery because there's no more price discovery. People are just essentially even as they put away money in retirement, they're essentially just blindly putting money into if it's the S&P 500 index, you're putting, blindly putting your money into 500 names, right? And so that you're ruining price discovery, and that this will Michael Burry from, he was the investor featured in the Big Short movie, but who got the 2008-2009 financial crisis famously right. But he said the same thing, that it was ruining price discovery, and that it would eventually cause a bubble.
Based on my height and efforts at the gym, I'm going for the name Big Short as well. Simon, is the retail investing craze, and it's a weird thing to talk about, but there's a lot of new money, dumb money for the most part in the market. Is that offsetting some of this? Though I'm not entirely sure the Reddit investors are buying, shares of Starbucks and Microsoft or other heavily owned companies.
It's herd mentality that we need to be aware of, Dan. And I think it favors the investors like us that want to do our homework and see if this seems reasonable or not, right? When you see a company that misses a quarterly earnings report by 1 penny on earnings per share, and then the stock sells off 17, 20%, crashes, that's not normal. That's algorithmic trading that's got billions of dollars behind it that just is saying, oh, that's a miss, we're selling off. Individual investors can take opportunities like that to buy into great positions that sell off for the wrong reasons. It works the other way too. Say there's a ton of money flooding into a premature technology that isn't ready for mainstream, it isn't commercialized yet. We start to see bubbles. you're locked into some of those bubbles if you're buying into the ETF that has a basket of those stocks. If you're selecting individual companies, you don't have that same kind of exposure. So I think net, this is actually a kind of an exciting, good time for those that are willing to uncover some more stones and do some more homework.
I want to speak to the comment from SoFly Marketing because it kind of brings up a point. We are not saying don't invest in your 401k. Sam, if you want to bring that one up, happy to share it with the audience. My 401k doesn't let me pick individual stocks. I only put in enough to get my employer match because at least that's guaranteed 100% investment. Absolutely. So what you want to do in your 401k is use the tools it gives you to match your investing style, your age. There's only so much you can customize in your 401k. I am a company to myself, so I have a little bit of control over my 401k, but it's still only what's available in the tool that, in the payroll company I use that has the 401k. You can only pick so much, but company matches are free money. So I don't care how well you think you're going to do in the stock market. If you have a 5% match and you put the money in, the amount you're allowed to put in, that is a guaranteed return on top of whatever you get. So even if you just perform with the market, so it's about 9% a year on average, and you got an extra 5%, that's going to push you into some really strong returns, and they're guaranteed. You don't want to give that up. So yes, this could be a problem, but it's not a problem because of the $6,000 a year you're putting into your 401k. Simon Erickson, let me give you the last word before we move to what we're watching.
I think the biggest overall win for investors from this entire trend, Dan, has been the reduction of fees. It used to be standard that hedge fund managers were making 2 or 3% of the assets under management just as a management fee. It used to be when you were trading stocks, you sometimes had to pay commissions. You remember when it used to be $20, $50 just to buy a stock. Now we're not even talking about any commissions at all for buying individual equities. And all that information that kind of used to be behind the curtain is now available for people that are interested to take advantage of. And so when you're paying lower fees, and you're paying 2 or 3% lower fees, you're getting by definition, a 2 or 3% better return on your results. And now that you have access to buy and sell securities at an individual level, this is going to return. This is going to be a net win for individual investors because you're getting better returns. That's the biggest innovation of all. And when we look at the kind of higher level of how capital is moving around out there.
No fee trading has changed my investing style because back when I had sometimes your account would give you X amount of free trades per year. So you'd have to think about, okay, like I'm going to buy this stock and I'm not going to buy 1 share a week for the next 10 weeks. I'm going to have to wait 10 weeks until I have the money to buy 10 shares. That affects your cost averaging. That affects your buy-in price. It shouldn't matter in the long term, but it matters from like a psych point of view. Like I know I have a couple of stocks that are 7 investing recommendations of mine that I own from before we invested in them. And some of them I go, oh, if I could only have had that at the point I bought it, it's up 80% in my portfolio, but it's only up 22% in the 7 investing portfolio because we bought it at a different time. So we've created that sort of rhythm, which makes sense for 7 investing members. And with that, Simon, let us reveal our contest winners and let's tell the people what they've won. Matt, when you become a member of 7 Investing, you get our monthly picks. We each make our highest conviction stock pick each month. The 6 of us, soon to be 7 of us. I think we can tease that we may have something coming down the pike on that front. I won't say any more because I'm not entirely sure what I'm allowed to say. But Simon, feel free to say more if you want. You also get access to our members-only calls. What's awesome about the members-only calls is 1, we all wear our members-only jackets, and 2, we talk about, I got a visible laugh. That's never happened. And we talk about your questions on our past picks. So a lot of people want us to update our picks, and we do that through subscriber-only updates in text, but we also do that on our calls. We also do the new member call. We sort of talk you through how the service works, what our thinking is, what our rhythm is. It's ever-changing. It gets ever better. I know I'm working on doing a big update, like a paragraph on every stock I've picked, plus some that I've picked up that were team picks or picks from people who are no longer with us. By no longer with us, I mean they work elsewhere, not that they've died. But Simon, who are the winners of a free 1-year membership to 7 Investing? And remind the people why they're winning.
Yeah, that's right, Dan. So like we said, we had a kind of the contest throughout the entire month of March. We promised to randomly select from the submissions that we got. We now got huge number of people that told us that they love Seven Investing. So thank you for sharing the story. Let's see, Sam Bailey, do we have a chart or graphic? There it is, perfect. Here are our 7 winners that will be reaching out to you via email that have submitted testimonials about how Seven Investing has empowered them to invest in their future. Thank you to each one of these winners. We'll be sending you the details of your 12-month free subscription to Seven Investing. We really appreciate everybody for kind of sharing their story. This was really powerful, I think, for everybody on the team to see the impact we're making out there. It really made me very proud of what our company is doing.
And if you're watching Seven Investing Now right now and you are not a member, first of all, what are you doing? Second of all, you can join us for $17 a month or $170 a year. This is the biggest bargain in investing services. I actually sat down with my aunt who has significant money in the market, and she told me, I've told this story before, she said, why are you charging so little? And the reality, you could charge way more. The reality is we want to make the market something for everybody. The 17-year-olds I was talking to yesterday, we want to make that be something that they can invest in. I don't care if they're investing $10 a month. We want them to understand that you don't have to chase the next GameStop or other, fundamentally bad investment, that you should own good companies, hold them forever. We will talk about what forever means in the home stretch of today's show. But Sam Bailey is our director of marketing. We should point that out. She is also the woman behind the glass who runs this show from a technical point. Sam, show the people how they can subscribe. That is, of course, seveninvesting.com/subscribe. We would love to have you. Next week is the 3rd week of the month. We're going to have our new member call, our subscriber call. So it's a great time to join. You'll get access to last month's picks and every month's picks, and not just the picks. We have a scorecard that shows every stock we've ever bought, and we actually do purchase the stock at the time we release it at the end of market on the 1st of the month. So you can see all our winners, they're mostly winners, and the occasional ones that haven't done so well. Full transparency, but we are crushing the market overall. Let us move to what we're watching. Steve, you wanted to talk about President Biden's green jobs plan. This isn't like jobs on golf courses or in solariums. This is an overarching green jobs plan. Take it away.
Right. Biden unveiled his green infrastructure plan last week. He's calling it the American Jobs Plan, and it's aimed at improving the country's infrastructure and transitioning to greener energy over the next 8 years or so. The cost is steep. About $2.25 trillion is what he's proposing over the next 8 years. And there's a lot in there. It's over $600 billion allocated to transportation. That's roads, bridges, public transit, waterways, airports, electric vehicles. $400 billion toward home care services and workers. $300 billion toward manufacturing. A lot of that's in the semiconductor and medical manufacturing spaces, housing, water infrastructure, schools. $100 billion toward providing every American access to affordable broadband internet. There is a lot in here, but there's countless ways to really take advantage of this as investors. And we've actually wrote about this just prior to the election several months ago in some of our kind of advisor perspectives articles. You can find some winners from a Biden presidency if you go search the Yext toolbar on our website. And but I think some of the most interesting ways to play this are electric vehicles and some of the green energy plays. And there's a lot in there. Like 500,000 electric vehicle chargers they want to encourage. They want to have stipends and credits for Americans to buy more electric vehicles. And it's not just, the Teslas of the world that you can play this. There are several ways, and I think you should stay tuned for maybe some of us to start talking about ways that you might take advantage of that.
Let me give some process talk and a word of warning here. So process-wise, some version of this is actually likely to pass through Congress because I'm not going to get into the technical reasons, but they're allowed to use something called reconciliation, which lets them pass it with a bare minimum. They don't need 60 Senate votes. It is possible that in manufacturing-driven states, you get some Republican votes, but historically, that has not been how our Congress has worked, without getting political. But this is very likely to, in some form, probably slightly slimmed down, but in some form to pass. But I would also say, when you're investing in companies in the green space, Do it because you fundamentally believe in the company, and this is the hot fudge on the sundae. Don't do what a lot of investors did when Biden was elected, and they went, oh, I'm going to invest in cannabis because, of course, the Democratic Congress is going to, well, they're not going to. That's not a Biden priority. It's not something they're going to touch upon. So you want to look at electric vehicle companies that will see their growth accelerate because of this, and whatever it is, solar, you need to look at fully understanding the full company. But Steve, there's a specific focus here on electric vehicles. I know I drive a hybrid. Does anyone else on the team drive an electric vehicle? I do it to feel better about myself, compared to other people. But do any of you have an electric vehicle or a hybrid vehicle?
No, but I am seriously considering picking one up in the next several years. I'll have a young driver coming up in about a year and a half here, and then several years down the road. I've got a 10-year-old as well who's going to be driving, and he's actually disabled, and I hope that he'll be able to drive properly. But I will really take a lot of comfort knowing that that there is potentially some self-driving vehicle technology that's advancing pretty rapidly that might kind of help that, and a lot of that has to do with, say, a company like Tesla and their leadership there. But I'm excited that the 500,000 chargers, like, people talk about the charging infrastructure being an issue. They're concerned they won't be able to get where they want to go. You can get pretty much anywhere you want to go, but the charger infrastructure is going to look a lot more like the gas station infrastructure in the next decade or so here. And we'll also see EVs transitioning, school buses, federal fleet vehicles. That's just the way it's going, and like it or not, it's going to happen. So, yeah.
We see your questions and comments. We will get to them after what we're watching, before we hit the home stretch. Let's seg to Matt's topic here. Matt, you wanted to talk about JPMorgan Chase CEO Jamie Dimon. He released his annual letter to shareholders. What were the highlights here?
Yeah, and his letter is always one of the better highlights of the year, I think. It always contains key insights on the economy, the stock market, the financial industry, and of course, JPMorgan Chase, one of the largest banks in America itself. But the two comments I'd like to specifically focus on today, however, pertain to Dimon's remarks on fintech versus big banks. And the first one he said was that the regulatory landscape gives an unfair advantage to fintech over big banks. And Sam, I think we have this graphic, but he included it in his letter. And he just listed everything that was basically the regulations the banks face, and the much lesser extent, the one that the fintech companies face. For instance, banks have higher capital requirements and much more extensive liquidity requirements, which means they can't lend out all of the deposits they take in. Deposits at banks must be FDIC insured. This cost JP Morgan $12 billion over the last 10 years. There are heavy regulations around how banks can use their customers' data, and are under a lot of KYC, which is know your customer, and AML, which is anti-money laundering requirements. And he goes, when I make a list like this, I know I will be accused of complaining about bank regulations, but I am simply laying out the facts for our shareholders and trying to assess the competitive landscape going forward. And then his second comment, thanks, Sam, for that. Fintech is here to stay. Banks must invest heavily in tech. He goes, importantly, big tech, and he lists Amazon, Apple, Facebook, Google. And as I said, now I'd include Walmart is here too. Their strengths are extraordinary, with ubiquitous platforms and endless data. At a minimum, they will embed all payment systems within their ecosystems and create a marketplace of bank products and services. That's the end quote. And he goes, so it's not time to but it's even with all that though. So the regulations landscapes, which heavily favors fintech companies, and just how banks are being targeted by big tech with really deep pockets and these very nimble fintech companies. I still don't think it's time to count out big banks as investments.
Let me jump in here, Matt.
Yeah.
There's also, and I jump in because you made a graphic about this one as well that I want to make sure we get to. Big banks also have a lot of advantages. They have some disadvantages. They're not as nimble. They don't have the tech wherewithal of an Amazon or other giant companies that are in this space, or an Apple certainly, which is in this space. But there are some major advantages that a JP Morgan has, right?
Oh, absolutely. It has branches all around the country, which is still a great customer acquisition tool. And I think you're seeing this, it's the same story that's being played out in retail, right, Dan? Where a lot of the brick and mortar retailers found out that their store footprint was actually a big advantage, and how online only retailers like Amazon are trying to find that infrastructure across the country. But like, so JPMorgan invested $5 billion in technology, $5 billion in technology last year, and that's going to increase to $6 to $7 billion this year. They have 41 million active mobile users. They built data centers around the world, which basically created their own private cloud, which is going to make it a lot more efficient. And listen to this. Like, so in his last conference call, this is what he says. He goes, you have a tremendous amount of AI being used in asset and wealth management, in trading, and commercial banking. It's literally the tip of the iceberg. Whatever we say today, 10 years from now, it will be probably 50 times more than we're doing today. And I would spend anything to get it done faster. So he knows where the landscape is going and he is committed to it. Bank of America is another big bank that really seems to get the importance of investing heavily in tech. Bank of America has 31 million mobile active users. There are now 17.2 million Erica users. That's Bank of America's virtual finance personal assistant, which is actually a pretty robust platform, and that's up 67% year over year. Digital channels now make up 45% of Bank of America's sales. Zelle volume for Bank of America users grew 80% year over year. So again, like, these companies are investing heavily in tech, and it shows up in the stock returns too. Sam, I think we have this graphic where it compares this is Bank of America and JP Morgan's returns over the last 5 years. They rival, the QQQs, like the NASDAQ ETFs, like total return too. Bank of America actually beats it, and JP Morgan is right behind it. So, again, big banks, a lot of banks have their hands tied behind their backs when they're going up against these fintech companies, but it's not time to count all of them out yet. And specifically, I think JP Morgan, Chase, and Bank of America are two very well-positioned banks going forward.
I use Erica like I use all AI systems. I endlessly type, give me a person, because invariably whatever you're trying to do is not this technology's come a long way. I joke because there are some things it can help you with. If you need to know how to say, do a wire transfer, and it's a very clear, concise thing, it can do it. If there's any nuance, and I'm not picking on Bank of America, this is true of every AI I've used. If there is any nuance to what you're trying to do, it is not capable of getting it. And it is maddening because it will refer you to things that are in no way related to what you're doing. I'm a big fan of automated help. It should be much easier to get a real person. I think that is a big failing. I think that's something that T-Mobile does really well, is giving you a real person that actually knows your issue. And there are lessons to be learned there. We're going to talk about Simon's, what we're watching. But before we do that, first, William says hello from Poland. This is a global show. And
Portland, I believe, there, Dan.
Portland.
Oh,
Portland.
Damn it.
Maybe it's Portland in Poland.
Portland is also very exciting. And I was going to use this to illustrate how this show is going to come to you from different places over the course of the next year. So in June, I'll be speaking at an event with our friends at Money Show, and we're going to do this show live from there. I'll be there. You guys won't be there, but we might have a guest on who's actually in the room with me, with, of course, all the appropriate social distancing. I'm going to be doing this show from the Bahamas this summer. I'm going to be doing the show from Cozumel, Mexico this summer. Max Chasko and I in February are going to be doing the show from I don't know where cruise destinations. So we're going to do shows, and I'm telling you this because we'll put it out on social media. And if you happen to be where I am, we hope, with all safety protocols in place, that you come out and watch the show or say hello. I promise there will be coffee. I will, I will buy the first round of drinks to people who come out. Simon, before we get to what we're watching, we actually had a question that we don't want to save till later in the show because we have a partnership that deals with this one. Sam Bailey, if you want to share the cryptocurrency comment, Simon, take it away.
Yeah, well, first of all, if anyone remembers the game Where in the World is Carmen Sandiego, we're recreating that. Where in the World is Dan Kline? Go out and find him and appear on our 7 Investing Now show. I think that's going to be pretty exciting. Thank you for Damon or Daman, however you'd like to pronounce this. Hi, everyone. Please bring someone who can talk about cryptocurrency. I'm so glad you asked. That's such a great question because right after this conversation, Steve and I are going to be having a conversation with our partners at Crypto EQ. We talk with their advisors there about what's going on in the cryptocurrency markets and what will that mean for the equity markets. And so, Steve, on tap for today, we're going to talk about Coinbase's coming direct listing, what that will mean. We just saw cryptocurrencies pass $2 trillion in total assets. What is that going to mean? And then we're going to talk about things like DeFi and Chainlink and some of these really emerging trends that are happening and what those are going to mean as well. So we do that as exclusive content. We put it for 7 Investing subscribers on the 15th of every month. But I think it's a really informed opinion that we formed a partnership with Crypto EQ to figure out what's really going on, what's the impact it's going to have on us for stockholders.
Our Grant 87 is watching in the UK. I'm glad you bring this up because that is another location we're going to be doing live shows from. I've talked about this a little bit, but my brother is a chief commercial officer for the Tottenham Hotspurs in the Premier League. He started that job during this summer, or during this month, really, with the pandemic raging. As soon as it's easy and safe for me to go to the UK, we will absolutely be doing some shows, likely from the Tottenham Hotspur Stadium, which by then might have a name, because that's my brother's job, is to get a name on that stadium. But Simon, we are going to talk about the markets, the stock market's very first publicly traded quantum computing company. I'd like you to talk about that company, but before that, could you also talk about what quantum computing is?
Yeah, this is something I've been excited about for a couple of years, and it's kind of exciting to see the very first way to play it in the public markets by buying a stock that is quantum computing. Quantum computing is not a faster traditional computer. It's a completely different architecture that can solve problems that traditional computers could not. And so Steve Symington knows as well as any of us how we've kind of built over the past couple of decades silicon chips with transistors that are based on binary data, right? It's either a 0 or it's a 1. There's no middle section. It's either on or off. And we use that to do tons of data operations, multiplication. It creates rendering for video graphics, all the cool stuff that we've done using CPUs, GPUs, and every other PU that's out there as a processing unit. A quantum computer is based upon a quantum bit. We call this a qubit, which is very different than the bits of 0s and 1s that we've gotten used to in traditional computers. And because that has much more of a wave function rather than just on or off in the binary notation we've gotten used to, it can solve extremely, extremely complex variables. So Dan, did you ever use goal-seek with Excel? Do you remember that?
Oh, dear God, yes, but I'm not good at Excel in any fashion, but absolutely.
Goal-seek, if you remember, I'm sure Matt and Steve remember this as well. You know, you try to go out and specify an output, changing the inputs. It'd go up and down a couple of times, then it would say, okay, we've optimized what the input needs to be to get that certain output. Take goal-seek and put it on steroids, where you can now have millions of inputs run through a quantum computer to have a very, very specific output. And so who's using this? DHL is using quantum computers for commercial logistics across the entire globe. Samsung is using this for the material science and design of superconducting materials. And a lot of biotech companies are looking at this for modeling out protein folding and molecules as they're developing new drugs. So again, Dan, things that have tons and tons of inputs cannot realistically be solved by traditional computers because it would take them far too long. Now have the opportunity to start doing these with quantum computers. Very exciting field.
And Simon, this is a very early stage company, right? Like they're going public via a SPAC, which means we don't have a ton of info, but their revenue is pretty small given their impending valuation.
Yeah, so IonQ is a company that's merging with DMY Technology Group via SPAC, Special Purpose Acquisition Company. That means you have a bunch of money that goes to a publicly traded shell with a privately traded company like IonQ. They merge together. All of a sudden, you have a publicly traded operating company. Dan, to put into context what you just said, IonQ did $1 million of revenue last year and is being valued already at $2 billion in this SPAC after merger. Now, by my math, it means they're selling by about 2,000 times sales. This is really, really expensive to pay for a stock like that. Quantum computing for most companies is still a science experiment that will not even have a useful quantum computer expected until the year 2025 or later. We're starting to see a lot of hype. There's going to be a lot of research still required in this field, but it's kind of neat to at least see some options available for investors.
That Simon, is this making you rethink these valuations, the 7 Investing SPAC? Because if you can have multiples of 200 times, that feels like really anything should SPAC. Like you should SPAC your paper route or your part-time job.
Oh, you're going to see a bubble form almost certainly in this field, Dan. I mean, like when you see 2,000 times sales for an unproven technology that isn't even really commercial yet. And plus on top of it, there's so many different types of quantum computing technologies, right? You still got MIT academic researchers looking at ion trapping, looking at optics for quantum computers, quantum annealers. I mean, there's not a generally agreed upon consensus of which is going to be the most efficient for qubit stability. What's going to happen, though, is we're going to pay close attention to this to show which does show the most amount of technical promise, and then which is actually showing the progress with the cloud computing providers who are eager to tap into this. Because right now, the companies like Google, like Microsoft, like Amazon, they're all using cloud computing and giving you access to GPUs, to CPUs, to FPGAs. Pick your processor that you want for the application that you have. And by the way, if you've got a really, really complicated application and you need the quantum computer, you're going to be charged a huge premium for access to it, but people will be glad to pay it if the problems are hard enough.
Every PU except Pepe Le Pew, who is being cut out of the new Space Jam. We're going to answer some of your questions in the home stretch, in our next segment. Matt, Simon, Steve, sorry. If you guys could mark down which ones you want to answer in the private chat, that would be great, because we're not going to have time for all of them. If we don't get to your question, it is not because we don't like you. We love each and every one of you. It is because sometimes we're not prepared to talk about that topic. It might be something we're considering as an active recommendation. It might be something we're doing a whole other show on. So we get to as many questions and comments as we possibly can. But we're going to go around the room now for the home stretch. When do you exit a stock? This question comes from Carlos Iueca on Twitter, and we're very active on Twitter at 7investing. We always appreciate your questions for the show. But Matt Cochrane, I will start with you. When do you exit a stock?
Well, so whenever you buy a stock, you should have a thesis for it. As in, like, why do I think this stock is going to do well? Why am I buying it? Obviously, you always buy a stock because you believe it's going to go up in value, or it's going to pay you enough dividends. It's going to be a good investment for you. Why do you believe that? And you should have a thesis going into every single stock. Now, the crucial question is, the crucial element is, you have to give that company enough time for that thesis to play out. And so often, many investors, they just basically cut and run at the first sign of trouble. That is often a mistake. Don't mistake price volatility or price fluctuations for like your thesis not playing out. However, after giving a company ample time to play out its thesis, if it's not working out, if for whatever, like there's been new disruptive technology in the space, there's new competitors, or it's just not executing well, then that's when you consider it's time to cut and run and time to sell a stock.
Simon Erickson, what can you add here on when you sell a stock?
Yeah, I mean, I agree with what Matt said. Bad performance, right? You figure out what matters and why you're buying the stock, not just earnings per share, not just stock price, but like what is this company? How does this company make its money, and what is it doing? I mean, operational performance, and companies that aren't cutting it. I mean, maybe one example recently is companies that have traditionally served on-premise software that have not transitioned well to the cloud. When it's very clear that workloads are moving to the cloud, I mean, that's bad performance for a company that should be getting ahead of that trend. That would be kind of just maybe one example that I would consider a company that's missing out on a bigger opportunity, bad performance operationally.
One of the other areas when you sell is if something changes in the company. So like if you bought, I'll give a silly example, but you invested in Restaurant Brands International because you love the Popeyes chicken sandwich. And if Popeyes then decides it's not going to sell chicken anymore, then that might be a big change for how you want to invest in that company. I know that's a silly one. Popeyes isn't going to pivot away from chicken, but companies can make decisions where you don't like their new direction, and it fundamentally changes your thesis. I'll give Steve the last word on this, and then Matt Cochrane, we'll go to you. You can tee up that comment and add your own question to Simon in it. Steve Symington.
As far as exit strategies go, not really a strategy, but my buy thesis generally has to be broken. I have to lose faith that the reason I bought the stock in the first place, really all of the above that we've talked about already, that the reason I bought in the first place no longer exists. Sometimes that can happen suddenly. And, those are the easier cases, with management fraud, where you completely lose faith in management, or, weird accounting issues or something, that basically the company is illegitimate. That shouldn't happen. If you really do your homework and you really deeply understand a business. But we've all been kind of surprised before, bankruptcies, things like that are very sudden. But yeah, the harder one is just kind of figuring out over extended periods of time that your thesis no longer holds and you've lost faith that they can execute. And sometimes it's disruptive new technologies like Matt mentioned. Sometimes it's just, you know what, it's time to cut bait on this stock and stop trying to reel it in. And that's the hardest decision to make, and really a case by case basis. So you'll notice that there's no specific, like, if my stock goes up 100%, I'm selling. Like, we don't do that here. We're looking for bigger long-term gains. So keep in mind, this isn't based on price action or candlesticks or technical analysis or anything like that. It's all the quality of the business.
Buy good companies and hold them forever. By forever, we mean until your thesis plays out, until you reach your goal. So if it's time to retire or buy a house or send your kid to college, you might want to exit some of your positions to pay for those things. That's why you invested in the first place. You are, of course, watching 7 Investing Now. I am Dan Kline. I'm being joined by Matt Cochrane, Steve Symington, Simon Erickson. We are taking your questions. This is an interactive program. It is not just interactive in that you can comment live. You can also comment to us on Twitter. That is @7. That is the number 7 Investing on Twitter. And we're there all the time. We had a explosion in Twitter fans. I'll thank our friend Brian Feroldi, who mentioned us as one of his favorite podcasts. And I know my Twitter went crazy, as did the 7 Investing. So we appreciate that. If you want to tweet out this show, tweet out your affiliate code if you're a member, we appreciate that. But Matt Cochrane, you wanted to tee up a question in the queue on Google and add a little bit to it for Simon to answer. Why don't you go ahead and do that now?
Yeah, for Simon or Steve, I don't know who would be better, but it's from Investee Easy. I think I'm saying that right. He goes, isn't Google also a big play in quantum computing space? Their computer had broken processing barrier. The only thing I would add to that, again, to either Simon or Steve, what about Microsoft too? I know they're doing stuff in quantum computing, but for laymen like me, sometimes it's hard to discern, is this real or is this just more like a PR push? So what say you?
I'd love to take this. So I know Microsoft has been working for a long time on quantum computing technology, and the trick is to make this broadly useful technology, and that's really difficult. So in Google's case, the what he refers to when he's saying their computer had broken the processing barrier, Google, I think it was like last year, they claimed quantum supremacy, right? Where their quantum computer had achieved a task that was virtually impossible for even traditional supercomputers to achieve. They completed some super complex computation rather, in like 200 seconds. And the same calculation, I think, would have taken like 10,000 years for even the world's most powerful supercomputers to finish. So that was, it was really interesting, but it was a very, very limited in scope application. It wasn't useful really in the real world. They're just saying, hey, our computer did something supercomputers couldn't. And what's interesting about, say, the company that Simon recommended is it's kind of the first like pure play quantum computing company out there. So Google and Microsoft and some other big computing giants definitely have their toes dipped in quantum computing waters. And I think Google had a follow-up experiment where they kind of scaled down, it was like 12 qubits or something, to solve like a chemistry equation that would be more useful, but it's very, very specialized right now. And the real breakthroughs are going to come when they can make this broadly accessible and to be able to handle whatever kinds of amazing problems they want to throw at it, like today's traditional supercomputers, or even just personal computers, which would have been considered supercomputers 40 years ago, right?
My first computer had a tape drive, like literally a cassette tape. So like you could like play Space Invaders and type. Coming to theaters June 2024, Avengers, Quantum Supremacy. No, that's probably not going to happen. But that quantum supremacy feels like a really ominous term. I'm not sure I like that one.
It's hard too, right? Because I mean, so often, I mean, for years, again, from my perspective, from like a lay person's perspective, for years you hear about AI, and all you heard about was IBM Watson and how great IBM Watson was, and it played Jeopardy and it beat champions, and you're like, wow, this is going to be like the big thing, and it wasn't, and it's just hard sometimes to discern like some like silly little things like these tech companies can like train their computers to do, and like what's going to be really useful and what's not.
That's the question, Matt. I mean, like the quantum computing race right now is kind of like the Olympics for swimming. You kind of had everybody that was incrementally shaving a half second off each other's time. And then all of a sudden the quantum computer called Michael Phelps jumps into the pool and just obliterates everybody. He's just so much faster by several seconds. I mean, we're going to talk for quite a few more years about who's got the most number of stable qubits. IBM's in on this, Google's in on this, Microsoft's on this. Everybody's claiming quantum advantage. Every qubit has error associated with it. And so you really need to error correct to make a quantum computer useful for commercial applications. And to do that, we might still be making these incremental steps for a couple of years, but the real game changer is going to be when you actually can error correct with a completely different architecture than what's even available out there. Ion trapping has been around for decades, right? Honeywell is working on something. I bet, there are companies that are looking 10 years in the future already, VC funded, that could completely put all of that irrelevant. So I think to answer your question, there's a lot of PR and hype in it right now, but there's going to be a, pardon the pun, quantum leap that happens here in the next couple of years in this field.
NBC, bring back Quantum Leap. That was my favorite show of all time. Ravi Shah, we appreciate you stopping by and saying hello. We always like when we get fun comments. I'm going to take one from Andrew H., and then we're going to take a question on AI that Steve is going to answer. Andrew H. says, if you had to pick 2 or 3 sector ETFs for the next 5 to 10 years, what themes would you go with? Cloud, fintech, for example. I don't think this way. I'm going to field this one myself. Like, when you invest in an ETF, you are almost always also getting exposure to companies you don't want to own. So I'm not a big fan of the chase the next big thing sector way of thinking. Like, are there good companies in cloud computing? Absolutely. Are there a lot of them? Probably true. But are there good companies in retail or cannabis or other spaces where if you buy an ETF, you're going to get a lot of dreck that you probably don't want? What we do here at 7 Investing is investing in individual stocks. We do the homework, we give you our picks, and you can create sort of your own ETF by buying multiple things in an area that you're intrigued in. Now, if anyone else wants to weigh in on this, please feel to jump in. I'm not bagging on ETFs or investing this way, but anytime I look at an ETF's holdings, there's always like 2 things that jump out of like, oh, it's like you get the meal and it has like one ingredient on it you don't want, it ruins everything. I kind of feel that way about ETFs. I'm getting a lot of head nodding, so I'm going to guess everyone agrees with me.
It's tough, Dan. I mean, like so many ETFs, they need to have something quantitative to track for the allocations, right? It's an algorithm that is weighting the ETF's constituents based on something it can look at, a number it can look at. And most of the time it's market cap, right? So some of these ETFs are just over allocating to the largest companies. As an individual investor, you don't have to do that. You can go out and say, hey, I want the 17th largest position in this ETF because I think that's the hidden winner from this trend. Sometimes a lot of that is kind of lost when you just do everything algorithmically.
Yeah, and especially in emerging spaces, like, if you look at, space or cannabis or places that are really emerging, a lot of companies are going to fail. And you don't necessarily want exposure to companies that you can look at and go, the only path to success here is a major change in the law or an acquisition. That is not where you want your money to be. We're going to take one more question here. Steve, I will let you introduce the question, as I'm not sure if you want to take the whole thing or just parts of it.
Sure.
And then, of course,
we could display it. It's from JE up about, would love Steve's thought on AI and watching since before the IPO, about when it was under 100 and again today. News seems good. Drop in price seems over emotional. Am I missing something? No, when he talks about AI, he's talking about C3.ai. This is an artificial intelligence stock, and people who follow me know that I am interested in that space, and I like that stock. I own it. And no, I agree. Its latest quarterly results were really solid, but this is post-IPO volatility and a combination of steep valuations and the really steep pullback in so-called growth stocks, SaaS stocks, relative to reopening plays. So I don't think you're missing anything here. And it's a really interesting company. So most certainly.
It has been a marathon. We appreciate so many of you watching. I'm going to say it again. Tune in for Monday's show. There's going to be something special on Monday's show. It is not one you want to miss. But Sam Bailey, let's tee up our finisher. We are up on the top rope, ready to drop an elbow here. Which of these is the best investment? Well, you got it sort of right. Only 4.7% said Dish. This is a terrible investment. Satellite television is being supplanted by over-the-top internet-driven television. There's very few people who still need a satellite dish. So satellites used to be marketed based on this is the alternative to cable, a way to not have to pay a traditional cable company. AT&T wasted a whole lot of money buying DirecTV about an hour before this whole trend took hold. I'm teasing a little bit about the timing, but I would not invest in either of those. My personal choice here by far is T-Mobile. We talked about them a little bit at the top of the show. T-Mobile going into internet, T-Mobile betting heavily on having a good customer experience. That to me, now I don't own T-Mobile, and here's why. It's an endless infrastructure investment. Like the second 5G is rolled out, people are going to start talking about 6G and then holographic 7G or whatever it is. So I look at the sort of like way the company has to invest, and that does scare me off because right now they are incredibly well run. They had John Legere as their CEO. They had sort of his lieutenant, Mike Sievert, took over. It's a different style, but he's done a really good job. I'm not so sure that that run can continue. And to succeed in this space, you absolutely need to execute incredibly well. Matt Cochrane, Simon Erickson, Steve Symington, would you like to weigh in? Is there any comments you'd like to add here?
I'll weigh in. T-Mobile is a great company, but it has a PE ratio of about 50. You can get Verizon for about a PE ratio of about 13, comes with a 4.5% dividend yield. So I'll take Verizon for this poll.
I think they kind of serve different purposes, really. T-Mobile's sort of being treated like a growth stock for the reasons you mentioned earlier, and I think that's part of the reason why the market's sort of demanding a premium or providing a premium valuation for it. But Verizon is more the steady play that pays a pretty healthy dividend, and I think maybe it's two different kinds of investors who pursue them.
I have one major rule when it comes to investing. I don't invest in companies that treat their customers poorly. Verizon and AT&T do not treat you well. I would argue that both of them are sinking ships. Great dividends, but T-Mobile is growing by over 1 million customers every quarter, and they've done that for like 6 or 7 years. I forget the actual number. That's not counting the Sprint edition. That's their organic, normal growth. So again, this is not a space I particularly want to be invested in, but if you had to pick one, I'm always curious to take sort of the temperature of the market. We appreciate so many of you voting in that poll, and guys, that finishes up this episode of 7 Investing Now. This ends our week. We all, of course, Simon, you want to give another plug for the podcast you're taping after this? Because we're not done. We're just done live.
Yep, we're chatting with Crypto EQ. Steve and I will be talking with their advisors about some impacts of cryptocurrencies on the public equity markets. And then on Monday, like you said, Dan, we got some pretty big news to reveal on 7 Investing Now. I'm excited about that as well.
If you would like to get a hold of us, that is very easy. info@7investing.com is our email address. Usually Steve answering that. That's questions about your membership, questions you're thinking about joining. You have some sort of process question. It's not really a place to say like, hey, could you look into this stock? If you want to interact with us or throw out some ideas, you can do that at 7investing on Twitter. We are very active at Twitter. We really appreciate it. If you're watching this show and you're enjoying it, tell people you're watching the show and you're enjoying it, because we want to help as many people as possible. And that's what we're doing. We're empowering people to invest in their future. So this is the end of our show today, but we will be back Monday. I'm Dan Kline, for Matt, for Steve, for Simon. We'll see you Monday.